Cold open shock reframe. This wasn't fundamentals. This wasn't fundamentals. This wasn't a sudden change in silver's real-world demand. What you just watched was forced behavior, rule-driven behavior, the kind that shows up when liquidity thins, margins tighten, and pressure is redirected instead of released. The market didn't discover anything new about silver. It enforced something. If the last move made you feel nauseous, if it pulled you into every tick, every spike, every sudden fade, that reaction is not weakness, it's design. Whipsaws are a feature of thin environments. They appear when the system wants participation reduced and emotion elevated. There is a structure underneath this stall that most people never see, a cash settlement pathway that can mute rallies without solving the underlying stress. In a minute, I'll show you the one signal that decides whether pressure escapes paper or dies there. Stay with me, because the next 14 days matter more than the last 14. I'll also map the 3 paths this can take, and only one favors patience. The market just showed its teeth, not because of metal, but because of mechanics. Under normal conditions, futures markets transmit stress forward. Rising demand, tight supply, or aggressive positioning builds open interest. And as contracts approach maturity, that pressure migrates toward delivery. Not everyone stands, but the possibility forces behavior. Spreads shift, margins bite, inventory suddenly matters. That's how paper begins to feel physical. What changed here is not silver. What changed was the route pressure was allowed to take. Modern futures systems are built with multiple release valves. Cash settlement options, offset programs, and netting mechanisms exist for one primary reason: to preserve liquidity and prevent localized stress from destabilizing the broader system. They allow positions to be neutralized financially instead of resolved materially. When those pathways dominate, something subtle happens. Open interest can fall sharply without a corresponding rise in delivery risk. Contracts disappear, but metal doesn't move. Exposure is closed, but not converted. The board looks calmer, yet the underlying balance between claims and material is untouched. Layer margin rules on top of that, and urgency compresses. Instead of a long arc toward delivery, you get short, sharp bursts of de-risking. Participants don't adjust, they exit. Hedgers roll, speculators are forced. Netting clears the books faster than supply can respond. That's how price can stall or even drop while participation collapses. It's not a lack of interest, it's an abundance of paper exits. Some of those exits are voluntary hedging decisions, others are non-discretionary. They look identical on a chart. Mechanically, they are not. This wasn't narrative, it was routing. In a moment, we'll look at why this felt violent even though nothing newsworthy happened. And later, I'll show you the one place this mechanism fails. When pressure finds a paper exit, price calms, but the system doesn't. Why it felt violent. Forced selling plus. Liquidity. What made this move feel brutal wasn't the size of it, it was the texture. In thin environments, order books lose depth. Fewer resting bids, fewer committed offers. That means even modest flows don't get absorbed, they travel. Price doesn't negotiate, it jumps. A few thousand contracts behave like a tidal wave because there's nothing underneath them. Now layer margin dynamics on top. When volatility expands, margin requirements rise. When margins rise, a category of sellers appears that doesn't care about outlook, thesis, or long-term value. They sell because they must. These are non-discretionary participants. They don't wait for levels. They don't stage exits. They hit whatever liquidity exists. Algorithms amplify this. Most automated systems are not evaluating silver. They're reacting to volatility, correlations, and order flow imbalance. When speed increases, they accelerate it. When spreads widen, they widen them further. They are not wrong. They are mechanical. As this happens, liquidity providers, who normally smooth movement, step back. Their models tell them risk has risen faster than compensation, so the very participants who usually absorb shock remove themselves. Gaps appear. Stops fire into air. Each break creates the conditions for the next. That's the cascade. Stops trigger margin. Margin triggers de-risking. De-risking triggers more stops. None of it requires a headline. None of it needs a story. And psychologically, this environment is designed to induce nausea. Fast reversals, incomplete candles, overnight gaps. It keeps participants glued to every tick, second-guessing every position, every belief. Not because someone is watching you, but because the structure rewards emotional response. Next, I'll separate what we can prove from what we can only interpret. And after that, the exact price behavior that flips this structure. Violence in price is often just silence in liquidity. Facts versus interpretation, credibility ladder. Let's slow this down and separate what we can measure from what we can only infer. This is where credibility lives. Fact, participation dropped as volatility expanded. Open interest declined even as ranges widened. That tells us positions were being removed, not built. Fact, margin requirements increased into that volatility while bid-ask spreads widened. The cost of holding risk rose at the same time liquidity thinned. fact, indicators tied to delivery stress did not expand in proportion to the price movement. The market moved, but the mechanisms that usually signal physical strain did not escalate with it. Those are observations. They don't need a narrative. Now the interpretations. Interpretation. When participation falls faster than price, pressure is being redirected, not resolved. The system is relieving exposure without forcing material outcomes. Interpretation, cash settlement pathways, and netting mechanisms make that possible. They provide financial closure without metal closure, reducing immediate delivery stress even during sharp moves. What we do not yet know is whether this redirection is temporary or sufficient. We don't know if underlying pressure is building quietly or dissipating structurally. And we are very clear about what would falsify this view. A sustained rise in delivery-linked signals, firming physical premiums alongside stable or rising open interest, or inventory behavior that tightens instead of loosens. That's the line between belief and measurement. We don't argue stories. We audit behavior. Now let's talk about the decision zone, the place where behavior changes. There's a tell here most people miss. We don't argue stories. We audit behavior. The decision zone, key levels, pull plus, behavior at levels. Most people are trained to watch single numbers, a line on a chart, a target, a breakout price, but markets don't decide at numbers, they decide in zones. A decision zone is not a tick. It's a region where positioning, margin pressure, and liquidity all converge. It's where the system is forced to reveal whether it can support higher prices without forced exits, or whether it must relieve pressure again. Acceptance above a zone doesn't look dramatic. It looks boring. Volatility contracts instead of expands. Pullbacks become shallow instead of violent. Open interest stabilizes or begins to grow alongside price instead of collapsing. Time is spent above the area, not just touched. That's how you know participation is returning rather than fleeing. Rejection is different. You see speed without structure, sharp probes that immediately fade, volume spikes paired with falling open interest. Spreads widen, the market moves, but fewer people remain in it. That's not discovery, that's evacuation. This is where cash settlement pathways matter most. Near stress points, they either fail, forcing exposure toward delivery, or they succeed, allowing pressure to escape financially. If they are still functioning, you get rallies that exhaust themselves quickly. If they begin to clog, behavior changes first, price second. This is also where many confuse breakout pressure with exhaustion. Breakouts build participation, exhaustion burns it off. One tightens the system, the other anesthetizes it. And this is your first reminder. The next 14 days sit inside this decision window. They carry more information than any headline. In a minute, we'll leave charts and go to the real-world tells. Because there is a paper-physical split forming. Levels don't matter. Behavior at levels does. Paper versus physical, premiums, inventory, delivery, real-world tells. This is where the screen stops being enough. Paper markets can vent pressure internally. Physical markets can't. Metal has to be sourced, fabricated, shipped, financed, and delivered. Those processes leave friction, and friction leaves evidence. Start with premiums. Retail and wholesale premiums are not opinions. They're tolls. They rise when supply chains feel strain and fall when access is easy. When futures calm, while premiums refuse to soften, that's not noise. That's the physical side, declining to confirm the paper story. Then inventories. Not the headline numbers alone, but the behavior of inventory. Are withdrawals accelerating? Are restocks slow, uneven, or concentrated? Does reported availability change faster than metal actually moves? These are signs of whether stock is abundant or simply being rehypothecated more efficiently. Delivery is the third tell. Notices, delays, roll incentives, and alternative settlements are where theory meets reality. You don't need explosions here. You're looking for persistence, small frictions that don't resolve, quiet extensions, repeated adjustments, the system working harder to make normal look normal. This is why cash settlement is so effective. It dulls urgency in futures markets. It allows exposure to be neutralized without metal ever being sourced. It reduces the visible countdown clock. But it does nothing to reduce fabrication demand. It doesn't create ounces. It doesn't speed refineries. It doesn't refill vaults. So real divergence would look like this. Futures volatility compressing while physical premiums remain firm or rise. Reported inventory steady while availability tightens downstream. Paper participation falling while real-world wait times stretch. That's not a rally. That's a split. Next, the three scenarios this can evolve into. Only one punishes patience. Paper can reset numbers, physical resets, trust. Scenario map, breakout versus fakeout versus washout. From here, there are only a few ways this structure can resolve. Not predictions, paths, branches. The system can take, depending on which constraints tighten and which release. Scenario 1, breakout path. This is the acceptance outcome. Price pushes into and holds above the decision zone, but the key is not the push. It's what follows. Volatility contracts instead of expands. Pullbacks become slower and shallower. Open interest stabilizes, then begins to build alongside price rather than collapsing. That tells you participation is returning. On the physical side, premiums remain firm or edge higher, and delivery-linked signals begin to show mild, persistent strain. Not panic, pressure. In this path, cash settlement pathways start to lose efficiency. They still function, but they stop anesthetizing the system. This is what real breakouts look like. Less drama, more structure. Scenario 2, fake out path. This is the relief rally outcome. Price pops quickly back into the zone or slightly above it, often on strong volume. But the volume decays almost immediately. Open interest falls again. Participation leaves as fast as it appeared. Premiums soften, even marginally. Delivery stress remains muted. Cash settlement and netting mechanisms continue to absorb pressure cleanly. The board may look impressive for a few sessions, but underneath, the system is still decompressing, not rebuilding. These rallies feel good. They do not change structure. Scenario 3, wash out then higher. This is the exhaustion outcome. One more volatility event, often triggered by a margin adjustment, liquidity shock, or cross-market stress. Price drops sharply, volatility spikes, open interest shrinks further. And this is where many conclude it's over, but physical metrics refuse to break. Premiums hold, availability doesn't improve, delivery behavior stays sticky, and then something subtle happens. Price stops falling, not because buyers rush in, but because sellers disappear. Forced flows finish, liquidity returns. The rebound is not explosive, it's uncontested. Every one of these paths is conditional. They don't depend on hope, they depend on behavior. Before you react to any of them, there's a mindset rule we need to cover. Miss this and you become liquidity. We don't need certainty, we need prepared branches. Risk, discipline, and positioning. Mindset. Before signals, before scenarios, there is posture. The first discipline in environments like this is separating observation from action. You can study a market without participating in its mood. Most people can't. They let every candle demand a response. That is how structure transfers risk from the system to the participant. Tick addiction is not curiosity, it's exposure. Fast markets reward stillness, not activity. They are built to convert attention into error. The more often you feel compelled to react, the more likely you are, responding to forced flows rather than meaningful ones. And that distinction matters. Forced flows are loud. They are fast. They ignore levels. They don't defend positions. Conviction flows are quieter. They build. They tolerate pullbacks. They change the texture of the tape. One distorts price, the other builds it. Volatility, in this sense, is not danger. It's information. It tells you where liquidity is thin, where leverage is strained, where rules are biting. It shows you what the system is trying to clear. Treating it as noise is how people miss the message and trade the feeling instead. Patience becomes a structural advantage here because most participants cannot hold it. They are pushed to do something, to recover, to average, to escape, to chase. Each emotional decision becomes a transaction cost. Each unnecessary action increases the odds that you are serving the market's need for liquidity rather than your own need for clarity. This is not a call to act or not act. It's a call to understand the environment you are in before you decide. Now the exact checklist I'm watching. This is where the trap reveals itself. What to watch next? Signals checklist plus time window. Here's the framework, not predictions, instruments. First, open interest. Watch what it does on rallies, not on drops. Rising price with falling participation is relief. Rising price with stable or expanding participation is rebuilding. That single relationship will tell you more about structure than any headline. Second, margin and clearing notices. These don't move markets emotionally. They move them mechanically. Changes in margin requirements, collateral rules, or settlement guidance alter who is allowed to stay. When those adjustments cluster around a level, they often define the next phase before price does. Third, premiums week over week, not intraday noise, direction. Are real-world costs of acquiring metal firming, flattening, or easing as futures fluctuate? Physical markets move slower, but when they refuse to confirm paper calm, it matters. Fourth, inventory behavior. Not just drawdowns, but replenishment speed. How quickly is metal replaced after withdrawals? Are restocks broad or narrow, smooth or lumpy? Friction shows up in tempo before it shows up in totals. Fifth, delivery behavior. Notices, incentives to roll, timing extensions, alternative settlements. You're not looking for crisis, you're looking for persistence. Sixth, liquidity depth, especially during quiet hours. Does the book refill or does it remain hollow? Do small orders move price more than they used to? Liquidity returns before confidence does. And over all of this, place a clock. The next 14 days sit inside a decision window. They carry more signal than most months. If even 2 of these align, the story changes. And if one specific rule shifts, everything accelerates. Interactive close. So as this develops, keep the frame clean. This wasn't about silver suddenly becoming more or less valuable. It was about how pressure was allowed to move. Mechanics over narratives, behavior over headlines. The market didn't explain itself, it expressed itself. Now I want to bring you into the process. First question. Which signal do you trust most right now? The behavior of open interest or the behavior of physical premiums? Second question. When paper and physical disagree, which one do you believe tells the truth first? Leave those in the comments. Not predictions, observations. This channel is built for people who measure, not people who chant. If you want ongoing calm intelligence briefings like this, focused on structure, risk, and the rules underneath price, make sure you're subscribed. These environments change fast, and clarity compounds. I'm watching one specific change that could flip this structure quickly. We'll cover it the moment it appears because it doesn't show up on the chart first. And remember this line because it frames the tension going forward. If we get another margin hike while price stabilizes, the next move could be faster than the last. The next phase won't announce itself. It will behave differently,